What if gold's $500 comeback is a trap? Gold crashed from nearly $5,600, broke below $4,000, and then staged a spectacular recovery from around $3,980 all the way back toward $4,450. Everyone can see the rally. The real question is whether they're looking at it the wrong way. Because if $3,900 was the bottom, gold could be preparing for another major move higher. But if it wasn't, this entire $500 recovery may have been nothing more than a massive bear market rebound. And if $3,900 breaks again, $3,700 comes back into play. Then potentially $3,500. Right now, both scenarios are still alive. Welcome to Grand Markets. Let's break it down. In July, gold came under enormous pressure. The $4,000 level finally gave way, and prices fell to around $3,980. At the time, sentiment was extremely bearish. Oil prices were feeding inflation concerns, Treasury yields remained elevated, and expectations of tighter Federal Reserve policy continued to weigh on gold. But gold didn't keep falling. Buyers stepped in aggressively around the $3,900 to $4,000 region. Gold reclaimed $4,100, then $4,200, then $4,300. As we moved into August, soft U.S. economic data and changing expectations around the Federal Reserve gave the recovery even more momentum. Following the latest CPI release, gold eventually pushed toward $4,450. From roughly $3,980 to $4,450. That's almost a $470 recovery in about a month. And that is the strongest argument for the bulls. If the $3,900 to $4,000 region wasn't an important demand zone, how did gold produce it? But there's a problem. Gold has repeatedly struggled between $4,400 and $4,500. And the last 48 hours gave us another warning. Yesterday, gold traded around $4,435 before reversing sharply. $4,400 broke. Selling accelerated, and gold eventually fell into the low $4,300s. Almost $100 disappeared from the intraday high. Today, buyers came back around $4,330 and pushed gold toward $4,360. But the recovery stalled, and gold moved back toward the $4,340 area. So when we zoom out, the structure becomes much clearer. There are strong buyers around $3,900 to $4,000. But there are also strong sellers around $4,400 to $4,500. Gold is caught between these zones, and whichever one breaks could determine the next major trend. So let's start with the bearish scenario. Could gold actually fall to $3,500? Yes, but $3,500 is a scenario, not a forecast. For that scenario to become credible, several things need to happen first. Gold would need to lose $4,200, then $4,100, and eventually break back below $4,000. But the level that really matters is $3,900. If $3,900 breaks, the entire rally from $3,980 could look very different. Instead of a new bullish cycle, it could be a bear market rebound. That would bring $3,700 back into focus. And if $3,700 also fails, then $3,500 becomes a legitimate downside scenario. But that move would probably require more than a technical breakdown. The macro environment matters. Gold pays no interest. U.S. Treasuries do. If inflation stays elevated and long-term Treasury yields stay high, the opportunity cost of holding gold increases. We saw that pressure again yesterday when rising yields were followed by a sharp reversal in gold. Now, let's look at the opposite scenario. What if $3,900 was already the bottom? Then gold needs to prove three things. First, future pullbacks need to create higher lows. If the next correction finds demand at $4,100 or $4,200, it tells us buyers are willing to enter at progressively higher prices. That's how a bottom starts turning into a trend. Second, gold needs to solve the $4,400 to $4,500 problem. Touching $4,450 isn't enough. Gold needs to break through $4,500, stay above it, and ideally turn that old resistance into support. And third, gold needs to prove that it can rise without constantly needing another headline or geopolitical shock. A genuinely strong market behaves differently. Pullbacks attract buyers. Bad news produces smaller declines, and breakouts actually hold. So where does that leave gold today? The $3,900 to $4,000 region has become a serious candidate for an intermediate term bottom. The almost $500 recovery from July is too significant to ignore. But there still isn't enough evidence to say the correction is over. Gold continues to struggle around $4,500, yields remain a risk, and the sharp reversal shows how quickly sellers can return. So forget the daily noise for a moment. There are two numbers that matter: $3,900 and $4,500. If gold breaks above $4,500 and holds, the case that $3,900 was the bottom becomes much stronger. But if gold falls back through $4,000 and breaks $3,900, the entire picture changes. $3,700 comes back into play, and below that, $3,500 becomes much harder to dismiss. The real question isn't about a $20 move tomorrow. It's much bigger. Was the collapse toward $3,900 the end? Or was this recovery simply a pause before the next major leg lower? The market hasn't answered yet, but $3,900 and $4,500 will give us the answer. This is Grand Markets. Subscribe for more gold, macro, and market analysis. This content is for educational and informational purposes only and does not constitute financial advice.